Hello, I am Edmond Jamna, and on behalf of DW Consult, I want to introduce to you Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, and shaky base in accounting to an expert position and to a place of confidence. It is also a platform to stay abreast in all matters of accounting. Tutorials on the Go is also designed to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as any tertiary accounting discipline. All that is required of you is to subscribe to our channel on YouTube at DW Consult and click on the notification bell to be part of it. Also, like and share the videos by way of inviting others to come aboard. Tutorials on the Go, bringing accounting to heart. Now, today's episode's lecture, government grants. So in this lecture, you're going to be talking about the funds granted to a business by the government for certain conditions or certain purposes or practices. We're going to first look at the definition. So government grants are the transfers of resources to a business by government in return for past or future compliance with certain conditions relating to its operational activities. The government assistance is action by government designed to provide an economic benefit that is specific to a business or range of businesses qualifying under certain criteria. So the economic benefit here can be monetary or non-monetary, such as land, building, etc. So the non-monetary are supposed to be measured at fair value. Let's look at the recognition of a government grant. So the government grant is supposed to be recognized when 1. There is reasonable assurance that the entity will comply with the conditions attached to the grant. Then 2. The entity will actually receive the grant. So grants should be recognized in the profit or loss according to the deferred income approach using the systematic basis. This means that the grant is supposed to be spread over the period in which a related expenditure is recognized. For example, if the expenditure is supposed to last for 5 years, the grant is also supposed to be spread for the 5 years. Let's look at other information relating to government grants. The first of which is that when a grant is in relation to an expenditure, it's treated as an income. You can recognize it by stating it separately in the income statement, maybe naming it as government grant or part of other income. Alternatively, you can deduct it from the expense with which the grant is donated or being given to the business and record the net expenditure in the financial statements. The second is that where the conditions has already been fulfilled in the past, but the money is now coming in. You recognize the grant in the period within which you get the money. Also, if the government is supporting a business in need of finances, where the business does not have future related costs to charge the grant against, you also have to recognize it in the financial statement in the year in which it becomes receivable. So the third point is saying that when a grant relates to depreciable or non-monetary assets measured at fair value, you can treat it as the first one. You set up a deferred income in the non-current liability section of the balance sheet. Then you spread it over the useful life of the asset with which the grant is related. Alternatively, you can net the government grant off the assets for which the grant is coming in. Then you record the net and depreciate it over its useful life. Lastly, when a business at a point after it has received a grant realizes that it cannot fulfill the conditions again, the government grant becomes repayable. So what you do is that if there is a balance of the deferred income in the financial statement, the grant is charged off it, then the rest is treated as an expense in the profit or loss account. Let's test our understanding. Now, Winnie Limited bought an item of property, plant, and equipment for $10 million and received a government grant of $2 million. The PP has a useful life of 10 years and has no residual value. Now, we have to explain how the purchase of the property, plant, and equipment and the government grant will be dealt with in the financial statement of Winnie Limited. So let's move straight into the solution. Let's look at the first one. The PP will be capitalized in the statement of financial position as a non-current asset at its cost of $10 million. Then we'll depreciate it over its useful life, which is 10 years in this question, with a $1 million annual depreciation charge recognized in the profit or loss account. Then we'll find the current value. Definitely, the accumulated depreciation will be charged against the cost of the asset. Now, the government grant, which is for the depreciable asset here of $2 million, will be recognized as a deferred income in the non-current liability column in the statement of financial position. Then we will spread the government grant over the 10 years for which the asset is being depreciated. So there will also be an income of $200,000, which is the $2 million divided by the 10 years. charged to the profit or loss each year, as the depreciation of 1 million is also charged as an expenditure. So the net will be the $800,000 each year. Then lastly, the deferred income will be split at the reporting date between current and non-current liabilities. When you charge the annual figure from the government grant, there will be a balance. In this question, another 1/10 of it will be due in the next 12 months. So because it's going to be due in the next 12 months, it's supposed to be what? A current liability. So you realize that the government grant is 2 million. Annual charge is $200,000. At the year end, the balance will be $1.8 million. But another $200,000 will also be due in the subsequent year. So we'll charge that $200,000 as a current liability. Then the remaining 1.6 will be charged as a non-current liability. Let's look at the alternate solution. So here, the government grant will be deducted from the PPE of $10 million. Then the net of $8 million will be capitalized on the statement of financial position as a non-current asset. Then this $8 million will be depreciated over the useful life of 10 years with an annual charge of $800,000 to the profit or loss account. And the carrying value will also be ascertained by deducting the accumulated depreciation from the cost of the assets. So, ladies and gentlemen, this is where we draw the curtains on our discussion on government grants. I hope we've done our best to shed light on it for you. If there's anything that you require us to throw more light on, our doors are more than open. All you have to do is to drop them in the comment section below. Also, if you have not subscribed, click on the subscribe button below, click on the notification bell, and share with your friends. Till we come your way again by way of tutorials on the go, we sign off. Stay blessed. Poker.